Hello there, it's me, Stephen Thomas, with Reports on Housing. I'm coming to you on Friday, June 6th, and we're bringing another housing debrief. And just wanted everybody to know that what I'm a housing analyst. This is all I do, and I'm in the expectations business. So if you like what you see, then please like the content. Also subscribe to our channel so it helps out in the YouTube algorithms, because we want to properly set expectations to as many adults as possible. And we're not here to carve out any certain narrative. We're not doomer and gloomers, and we're not pom-poms all the time either. It's like, just, you know what's really going on in the housing market. That's what we are all about. So this week, we're going to dive into breaking. It's now a buyer's market for housing. So we like to call cracks when we see cracks in the market. It's a buyer's market. Let's talk about it being a buyer's market and what that means and where we're at right now today and where our expectations should be based upon the fact that we are now a buyer's market. So I need to set the stage as to how we got here. And you have to understand, in 2018, we hit 5% interest rates in November of 2018. But then interest rates started to come down in December, January of 2019. And you could see here that it was at 4.5% at the start of 2019. And it continued to make its way down even further, all the way until we started off the year with very nice rates, actually below 4%. And then we went into COVID, and then we got lower and lower and lower rates. 17 record low. This 17th record low because of COVID actually came on January of 2021, when we hit 2.65% across the United States. So you can see we were higher in rates, and then we really came down to these incredible low rates during COVID. And then as a result of keeping it down so low for so long, as well as not getting ahead of the inflation that we're starting to see in 2021, by the time we got towards around the fourth quarter of 2021, that's when the Fed changed their tune and said, we're going to have to increase rates. Well, they didn't start until March of 2022, but rates started to go up prior to that in anticipation of the Federal Reserve starting to increase rates in 2022. And boy, did they increase rates. It was at a faster pace than anybody had anticipated. And prior to that, we were stuck in these low rates from April of 2020 all the way until the first month, January of 2022. And then they went hog wild. They really ratcheted up rates, and they ratcheted up at a record that we had not seen before. It was the highest since like 1981 as far as the jump in such a short period of time. But this was different because they were already at a floor of like nothing, and then they went all the way up towards 5.5%. So going from 0 to 5.5 was this gigantic leap, and it was a major shock to the housing market and to the economy across the board. But the economy ended up being quite resilient still, even though we had these rates, as well as the housing market ended up being quite resilient. But now interest rates, interesting enough, went all the way from 3.25% and then blew past 7%, got up to 7.37% in October of the same year of 2022. And then they remained above that at 7% for quite some time. Now, as far as the overall housing market is concerned, how's the housing market been since they raised rates? It's been quite resilient. We had these really high rates, and affordability just absolutely plummeted. John Burns, he's an economist for new home builders. He does this John Burns index, and it's affordability, and it's this new index that actually takes into account insurance, because insurance has gone so up, and there's a lot of indexes that didn't bring in insurance. And since insurance is getting so expensive for houses, as a result, what you're seeing is that the unaffordability is at its highest level since the start of the 1980s. So it's very unaffordable right now because of where rates are at. So either something had to give, is what everybody thought. Either rates come down, or values come down, or incomes go up. And pretty much nothing's really happened. Rates have stayed the same, and incomes have been going up slowly, and we haven't really seen values come down either. But and we were stuck at that 7% threshold for such a long period of time, since October of 2022, all the way to where we are today. We're kind of been playing at right around 7%. Yeah, we've been a little bit less, but very, very close to that 7% threshold, which makes things quite unaffordable. And as a result of going in 2022 from 3.25 at the start of the year all the way up to above 7%. This is what happened to their pending home sales index. This is National Association of Realtors. And you could see there was a waterfall dive in pending sales activity. We like to follow this because it is actually it's like a prelude to what's coming on down the road. It's like foreshadowing, and it really does show you where closed sales activity is going to go. The closed sales activity really came down. There's a waterfall dive in closed sales activity as a result of pending sales activity going down. And you can see after that red line going down, the next mountain there is 2023. Then we get to 2024. And on the right-hand side, the beginning of 2025. And you can see it's just, I actually refer to these as the triplets, that it's the same amount of demand year in, year out since we've had rates that are stuck at 7%. And so you can see it here. 2021 is that green line. So we had a lot of pending sales activity, did the most amount of sales since like 2005. It was amazing the amount of closed sales that we did. And then in 2022, that's the orange line. You could see as rates got higher and higher, the orange line, pending sales, started to fall further and further until it latched on. You could see where since then it's the same year over year, because the blue line is 2023, the purple line is 2024, and the red line is 2025. So pending sales activity has been extremely muted. And yet the overall housing stock has been extremely resilient. It's like people are scratching their heads going, values were supposed to come down. They did initially in 2022, that shock of the system, but it was only an initial shock. And then all the homeowners collectively said, yeah, we're just staying where we're at right now. Sorry about that. We're not moving. And United States total housing inventory, April of this year, is at 1,450,000. Last year was at 1,200,000, and the 3-year average prior to the pandemic, that's 2017, 18, and 19, was 1,850,000. So we haven't even made our way up towards pre-pandemic levels. We are going to get there. I'll show you where we're at right now. But in 2008, there was a time, that was the time period where in 06 it was almost 4 million, and then 07 hit 4 million. In 2008 was just shy of 4 million. Had a lot of homes on the market. This is one of the main reasons why, for all those people hoping for a housing crash, I know I'm going to lose a lot of people right now. We're not going to see plummeting prices. We're not going to see a bubble that bursts, or we're going to see a crash in values. And when you have a housing crash, we're talking like down 30% in values. And we're just not going to see that kind of a marketplace. It's just one of the healthiest housing stocks of all time. Yet there is still pressure on prices, and we'll get to where that pressure is right now. But in 2023, what the story was, in 2023, you could see we didn't build a lot of inventory. As a matter of fact, it was kind of flat. Usually it's a nice little hill where you get to the middle of the year, and by the time you get to summer, it peaks someplace in the summer and then comes down. But 2023 was so flat. In many of the markets that we track, it actually was going down all the way from the start of the year until we got to April. And in some markets like Las Vegas, it went from the start of the market until June. It took forever for it to bottom out so it could start to rise. And so what had happened was that we were at these really high rates, and these high rates going from all these people that had these low rates that they refinanced in 2020 and 2021 and the start of 2022. People either purchased or they refinanced these very, very low rates. It might be stuck above 7%, but once it hits that 7% or higher, it really precluded a lot of people from placing their homes on the market. And we actually refer to that as hunkering down. You might have heard it as locked in, that these people are locked in, they're not ever moving, the golden handcuffs and all that stuff. But it's actually what we deemed called hunkering down. A lot of them could actually still make a move, but they didn't want to trade in their low interest rate for a big, giant, fat interest rate and higher property taxes and all that good stuff. They said, you know what, I'm just going to stay put with where I'm at, because back in the first quarter of 2022, 86% of the United States had an interest rate at 5% or lower. 65% had an interest rate at 4% or lower, and 1 out of every 4 people that had a mortgage across the United States had an interest rate at 3% or lower. Now understand that 40% of everybody across the United States owns their home free and clear, so the rest of the 60%, 1 out of every 4 had an interest rate at 3% or lower. Now I want everybody to know that these numbers, that was the first quarter of 2022, they've all been massaged down. It's now only 20% have an interest rate at 3% or lower, so it's now 1 out of every 5. So some of these people did still sell their house and do something else. And people are going, yeah, who does that? There are people out there that do it, that decide, hey, you know what, this is the time I want to sell my house, maybe go rent or go buy something else. There's a lot of people that have sold and bought, and people are going, how? There are people out there that have these dual incomes, that have they have all this money, or they're getting money from a relative or something, that says, you know what, I want to go do it, and they're doing it. They're pulling the trigger. And you could see that as a result of having these really low rates, a lot of people decided, and this shows you where we were in 2023, this is the deficit in the number of homes listed compared to 2017, 18, and 19. So what this does, and it's something that we do similarly, we take each month and look at, okay, what was that month prior, 2017, 18, 19? How many homes normally come on the market? You could see when it's negative 51%, that means half of the market isn't coming on the market. And that's what happened in 2023. And during the pandemic, we had a lot of people not come on the market because of the pandemic. And then we got to 2023, and the second half of 2022 is when it all started. A lot of people didn't come on the market because of the fact that interest rates were so high and they had a beautiful low rate. So why are they going to move? So you could see that in 2023, a lot of people decided not to move. And so as a result, not a lot of people coming on the market. And yet, when you didn't have that many people on the market, the inventory couldn't build. And as a result, there was still not enough homes on the market. And we had a seller's market pretty much across the United States. And values continued to rise in spite of the fact that we had these higher rates. So that was kind of this issue that was it's just a head scratcher for so many people. And then we got to 2024, and all of a sudden, wait a minute, more homes are coming on the market. There are more homes than the last year. So we have the inventory was actually, because we had the same amount of demand, yet there were more homeowners coming on the market. There was more sellers competing against each other, more people now playing, and those extra people, because the demand had not changed, pending sales activity hadn't changed, now you have these extra homes accumulating, building the inventory. And so you could kind of feel the shift that, you know what, it was a nice seller's market, but you know what, more people are coming on the market than the prior year. It's still a deficit compared to where we were prior to the pandemic, yet it is getting better and better each and every month. And that's what this isolates from ICE. They put this thing together on a monthly basis. So the market towards the end of the year was feeling in 2024 a little bit more balanced. So it's no longer a hot seller's market, more of a balanced market. And we did see a peel back in prices in a lot of areas because we were in the fall market. A lot of people that were unsuccessful during the spring and summer that still wanted to sell, they might have had to, shave a few $1,000s off their asking price in order to become a successful closed seller. So then it brings us to 2025, and 2025 is where things really began to change. We still have the same amount of pending sales activity year over year, and it's been stuck there now. All of 2023, all of 2024, now we're in 2025, same pending sales activity, yet even more homes coming on the market, even more. And you can actually see that. That's on the right-hand side. It's getting to be, you know what? Yes, we're off from the 3 years prior to the pandemic, but it's getting very close to the same number of homes coming on the market as we placed on the market prior to the pandemic. So you could see that this has been the evolution, that it's going in this direction where there's more and more homes coming on the market, that we don't have this deficit on a monthly basis. So they're accumulating really fast. And as a result, this year feels a little bit slower, a little bit more sluggish, lining up in favor of buyers. And that's kind of where we are at today. And year over year inventory growth, you can actually see where was the most inventory growth. If it's really that nice dark hue of blue, that means inventory growth year over year is up by a lot. And you can see, where's it up by a lot? Well, I'm here in Southern California. It's Southern California. It is Las Vegas. It is up in Seattle. And you could see it's in some places in Florida and the Carolinas. So, and in Denver, that's another area that we're seeing it quite a bit. So, that and year in which for sale listings will reach their pre-pandemic levels, and you could see that. For a lot of them, they're actually recovered up in the Bay Area. The light blue means that sometime in 2025, it's going to come up to where they were prior to the pandemic. And so there's a lot of markets that are already there. There are some that are going to be there this year, and there are some that are not going to recover anytime soon. And that's, you could see where that is. That is that Midwest, the upper Midwest, as well as the East Coast, the Northeast, where we have there's still very, very limited supply. So you have to know where you're at. If you're in one of those markets, they're still hot and singing because they don't have the necessary inventory. There are some markets that are making up for that, and it's pretty much Texas and Florida and Idaho and Tennessee that are making up for the differences that are in the Northeast and along the upper Midwest. And you can see this is interesting, and this will just show you active housing inventory for sale compare in April of 2025 versus April 2019. And you can see that where is there extra homes on the market? Well, there are some in the West that are awfully close and that have made it, and that's Idaho, Utah, Colorado, Arizona, Texas, Tennessee. You're also seeing Florida on there, and many are going to make their way back up there. The ones that are a lighter hue of green, or if they're a light shade beige color, they're going to make their way back up towards the pre-pandemic levels. And so now there's been this shift in supply and demand. And if demand isn't changing, yet you're pushing more and more on supply, all of a sudden it shifts in favor of buyers. And the only way that this goes back is if you already have that supply that's extra, is you have to have more buyers and more buyer demand. The only way you're going to get that is by either prices coming down or interest rates going down. So we'll get into where we're at. But first, let's bring in our sponsor. And our sponsor this week is Mike Grambow from JMJ Financial with the Thibodeau Morel Group. He can be reached at 714-794-7668. And there are a number of different non-QM loans that he could put together with you. He's an expert in his field. For borrowers who do not meet the usual guidelines, they have programs wrapped around the bunch of programs for those people that can't, quite do the normal guidelines. So this is for your real estate investor. This is for your real estate agents. These are for self-employed borrowers. They have 12-month bank statement programs. They have 1099 only programs. They have no income DSCR loans for investment properties. They have an exciting alternative loan product that's an income from P&L statements without further documentation of bank statements, tax returns, or pay stubs. They need a letter from the borrower's CPA verifying the P&L. And they close as fast as 14 days, both on purchase and refinance. And you know what? Have Mike Grambow with JMJ Financial work for you with the Thibodeau Morel Group. Mike can be reached at 714-794-7668. That's 714-794-7668. And now back to the program about this shift in the amount of demand and supply. Well, we're getting more supply, yet demand is not changing. And so as a result, this is where we are as far as different home price indices. They're very, very similar across the board. And this is not median sales prices like so many media outlets quote. This is actually home price indexes where it's like for like properties. What are they doing over time? It's not as jagged as following the median the median sales price. And you can see that I'm pointing to that the blue bars. That's 2023, and you can see that's each month's change. You can see that in 2022, to the left of the yellow, my yellow arrow, you see how values came down towards the end of 2022, and that was going from 3.25% to 7.37% in 2022. But that's 2023 right there. Then along came 2024, and you can see month over month, while it's still up, it's not up as high as 2023, and that's because we were adding to the inventory. And now, flash forward to today in 2025, and it is barely up month over month, and that's during the spring market, the hottest point of the season. And usually as things languish and they accumulate over time, now they're competing against each other. You get into the fall, or you get into the market where it starts getting a little bit slower, and you have either sellers that pull their homes off the market because they don't really have to sell and are not going to give away the farm, or you have some that'll say, hey, you know what, I'll come down a little bit in price. And that is the point that we're at right now. Because year over year in March, we were up 2.4%. Year over year in April, up 2% across the United States. Year over year, May, up only 1.6%. Now, for May, this is actually kind of an estimate that ICE did, but they feel that it's very close to that 1.6% year over year. But you can see where it's going. It's going to the point where later on this year, it's going to be like net zero year over year. Actually, it's going to come down a little bit in many, many markets. And across the United States, we have already talked about how Zillow thinks it's going to be down 1.7% from March to March, March of this year to March of next year. And then you have Redfin that just came out and said it'll be down 1% by the end of this year across the United States. Might not be that far off, but we're talking 1%. Year over year changes in National Home Price Index. There's a whole bunch of different indices, like I said, and none of them are currently negative. There is one that is close, and that's Zillow Home Value Index that is at 0.7%. So that's the only one that is close. So, but these are a bunch of markets. It's hard to imagine, but there are actually a bunch of markets. There are 300 metros that are tracked by a Resi Club, and out of those, 80 are negative. Some of them as low as 0%. Some of them are a lot higher. And the ones that are a lot higher, they're these small little communities that are in Florida. And you can see most of that is Florida, Louisiana, you got Texas that's in there. You got Florida. It keeps on Florida, Louisiana. You can see it's those Sun Belt states all the way along. And then you get to Georgia and North Carolina about two-thirds of the way down. And then you get to some of the Bay Area, almost down towards the bottom. And you get to Hawaii and Colorado and Tucson, Arizona. So there are some that are on there that are not down as much. You can see those are actually in about 2% or less that have come down. And this is, of course, annually where we're at. So overall housing market looks like it's really slowing down. And you know what? There's going to be not that many people that are going to get into pickles. This is not like the Great Recession, which is why you're not going to get values come down like crazy. You will get some areas, and you're going to get a lot of reporting, especially from those doom channels. A lot of them that just love it. They actually get on CNBC and different news outlets like Yahoo, and I've seen the quotes come out, and it just makes me scratch my head because these are the same people that have been talking about doom and gloom in real estate for a very long time, for the last 5 years. That's just not what's going to happen. There's not this real sense of urgencies for any sellers to that where they feel like they absolutely have to give away the farm in order to get out of their house. That's just not going to happen. So there's going to be this real stickiness to pricing. And if they're not able to get their price, well, shoot, they'll just stay put and enjoy their low fixed rate. And that ultimately is what's going to prevail. But there's going to be some people that are still going to want to do it. So that's where they come down a few $1,000s over maybe the last sell in order to get sold so they can go do what they want to do. But nobody is going to be giving away the farm. We don't have banks. We don't have foreclosures. We don't have short sales. We're at a national delinquency rate that's really low. Great credit scores, great jobs across the United States. That's not going to happen. And understand that as far as sellers are concerned, at the end of the day, we know, because many of us have been sellers before, we want every last penny, every last dollar that we can get. And we're just like this lady. We're going to make sure that we don't give away anything. And that's pretty much the way that it works, that people want to get their price. And if the market's not agreeing with them, shoot, I'm just going to enjoy my low fixed rate. So until rates, the only time that we're going to see a whole bunch more properties come on the, actually go into escrow, go in pending status and sell down the road is when rates come down. That's going to be the real change. Until then, we're going to get values that come down slowly, probably in the neighborhood of the less than 2% type kind of thing, close to what Redfin's talking about, 1% by the end of this year. So some markets, yes, they're going to come down a little bit more. Some markets are going to be net positive, but overall for the United States, down about 1%. And it'll be the same thing for 2026 is what it's looking like right now. But if we get more homes that come on the market, it'll come down. But what we're starting to see in many, many markets is inventory is starting to kind of like tap out a little bit early because there's a lot of homeowners that are going, yeah, I don't want to play in this kind of a market. So once we get back down towards where we were in the fall, 6.1% interest rates, you will see a change, a definitive change in the market. So we're stuck at 7, but if it just made its way down to 6%, all of a sudden we would have a different marketplace. We saw markets jump as much as 10% during the fall when it's never happened before. So we're waiting for the economy to slow down. A lot of people think it's the second half of the year, kind of matching up with what happened last year around July. That might be a repeat again this year. So that's where we're at. And you know what? Like, subscribe to the channel, like what you've seen, leave some comments. You know what? I invite everybody to leave comments. People leave all kinds of sorts of comments. Remember, I'm a housing analyst. I have a quantitative economics and decision sciences degree where this is all I do for a living. I'm a housing analyst. So come at me with any of you, any questions you have or anything you'd like to see in the future. But go to reportsonhousing.com to subscribe or more information of all the markets that we have reports for. Our most recent one that came out is called Myth Crushing, and there will be a new report that comes out this coming up week. And if you'd like a free month, go to reportsonhousing.com and utilize the coupon code BUYERS. Thank you so much for tuning in to yet another housing debrief. Appreciate it.